Hello, I'm John Jannarone, Editor-in-Chief of IPO Edge and CorpGov, here from the New York Stock Exchange. We have a really interesting topic today. We're going to talk about clean energy. Some of you may know that last month the International Energy Association released a report on global investment in clean energy. 1.7 trillion in investments is expected in 2023. So for the first time, that's going to eclipse on the solar side more than fossil fuels, which is remarkable. Joining us to dig deeper into this is Eamon Nolan, who is a project finance attorney from Vinson Elkins. Eamon, thanks for joining us.
John, thanks for having me.
So we've interviewed a lot of your colleagues, but we're excited to have a new attorney here to talk energy. Very fitting that we have the Shell sign behind us in the background. I love that. So as I just mentioned, we've seen tremendous investments in clean energy. It's outpacing fossil fuels. Does it feel like we've hit a threshold where there's no turning back?
I think it does. I think the IEA report has some pretty interesting concrete stats around what exactly those look like. And one of those is that for every dollar of fossil fuels investment we're seeing, there's $1.70 being spent on clean investment.
Wow.
So that's a pretty big number. 5 years ago, that was 1-to-1.
Wow.
I think the other big movement we've seen in investment in the fossil fuel space has been that traditional energy companies, oil and gas companies, are spending roughly half of what has been a pretty productive time for them, a very profitable time over the last 5 years. They're spending about half of their free cash flow back in reinvesting in the industry, which is way down from historical numbers. So we're definitely seeing a movement there. I think there's probably two things that have happened. One, we saw a number of years ago, LPs put a lot of pressure on their asset allocators, the PE managers that look after their money, to invest in more climate-thoughtful climate solutions. A lot of that was obviously driven by their constituents. And so we had sort of felt that push for, I think, a reasonable amount of time, that there was this inevitable movement towards this industry.
Yeah.
The other thing is obviously just, infrastructure and energy investors are opportunistic. They look for sort of stable cash flows, so stable revenue, stable costs in infrastructure and energy asset classes. And I think we've seen, particularly over the last 10 years, things like onshore solar and onshore wind have become very mature markets, and they are just asset classes that people can frankly turn a return for their investors, and so that's pushed it. Obviously, there's been some other accelerants globally, whether it's sort of Paris Accords, tax changes, subsidies, that sort of thing that have helped to push it.
And we're going to get into the tax subsidies a little bit later, but let's break down clean energy a little bit. So in fact, on our program, not here at the New York Stock Exchange, but on our remote interviews, I've talked to dozens of companies, many of them probably your clients in the clean energy sector. So we're talking about, as we've discussed, solar, wind, nuclear, batteries, all kinds of stuff like that. But there are also some emerging technologies that have not been around for long, like hydrogen.
Right.
So those are inherently riskier, right? So how do investors feel about that?
I think they're inherently riskier, and I think there's probably two ways to think about that risk. One is the sort of equity risk profile, and the other is how do you go and get debt financing for what are very capital-intensive projects. I think hydrogen doesn't so much suffer from a technology problem. I mean, it's at least not an insurmountable technology problem, because we've been producing hydrogen and ammonia as an economy for a very long time. What it suffers from a little bit as a clean solution is a cost problem. So getting the cost of clean production of hydrogen relative to historical ways of producing hydrogen, grey hydrogen is what people typically describe that as, getting that cost of lower the lower carbon intensity down. That's been a big problem. The other is that we have this existing economy in the hydrogen world, and obviously to create more demand for hydrogen, which is really, it's something we have to produce. It's not something that we can just pull out of the ground or take from the wind or the sun. It's something that needs to be made. And so as you kind of look at how do you then deploy hydrogen at scale, you need to change the offtake side of that. So you need to change the way we create steel. You need to think about mobility and how can heavy industry, instead of relying on traditional fuels for trucking or for forklifts or for mining, you need to be thinking about how do we change the equipment that they use so that they can then rely on that. So I think those problems are inherent as part of a global hydrogen economy. I think the other side is just the debt financing side, right? Like, you just need to go and get money from banks, and to build these multi-billion-dollar projects. They look at this risk very differently, and it really goes to that offtake risk. Like, how do we know that there's going to be this consistent revenue stream over a long period of time and get over that? But the technology side of it, I think that's probably a pretty solvable problem.
All right, great. So let's get back to this idea of tax credits,
Yeah.
and we were talking specifically about the Inflation Reduction Act.
Right.
That makes this a lot more appealing because you're getting those credits. Just tell us a bit about how that's going to work, and how much of an effect it's going to have. And by the way, Eamon, I've met people many times to this day who say, "Oh, I don't think that clean energy is economical at all
Right.
without subsidies." Is that true?
It depends on the asset class, right? I think, and it depends on what your return profile is as well. If you are looking to recreate traditional sort of PE style returns, energy even returns, it's probably not, right? Like you can't necessarily achieve those high teens or low 20s style returns in sort of just a traditional onshore solar project. Those projects are very de-risked, so it's hard to get to that place. But can you achieve returns? Absolutely. It's just depending on what that profile looks like. But the IRA has been, we talked about the fact that have we gone past a point of no return? I think we felt that way 5 years ago and 3 years ago before the IRA came. What the IRA has done is provide an enormous shot in the arm to anything clean, and it's one of the features of IRA is that it really provides tax credits, so the ability for people to take a credit on their income or to sell that credit and monetize it in some way, and be relatively asset class agnostic, meaning it doesn't have to be a solar project or a wind project. It's got to be a project that is effectively lowering the carbon intensity of existing methods of production of energy. And so there are lots of different ways that you can go about that. And what that does is obviously spur technology advancement, people to go into various more nascent technologies and take a bit more of a risk and say, look, we can actually do this. If we can produce clean hydrogen, we can get $3 a kilo as a tax credit and make that green hydrogen a cost-effective kind of proposition.
Great. I want to talk about nuclear if we can, just really quick here. So is there a need for credits, tax credits for nuclear, or is it already, can it already deliver big returns on its own?
Well, tax credits are available for, again, anything that you can kind of neutralize the sort of carbon intensity of power production. So there is the ability to get tax credits. Nuclear suffers, I think, from largely stigma problems. I think nuclear has the potential to be a critical sort of component of any decarbonisation of global economies. Obviously, there has been enough safety issues around nuclear power plants over the years that there are not only, obviously, in many cases, very justified regulatory constraints around getting new nuclear put to scale, but also just around the NIMBYism, so the not in my backyard kind of approach to nuclear. Lots of people would just, the ability to just go and deploy it in the geographical regions where you need load is very sort of challenging.
Great. All right, last topic, Eamon. So I think a big shortfall in clean energy has been its execution in emerging and developing economies. What is there to say about that? And by the way, that's got to be frustrating because those places are already got a host of problems as it is, right? So what do you think it's going to take for it to work in those places?
Yeah, it's hard to totally generalize about every region just because every region has its own challenges and but if you take Latin America, for example, and then sort of break down what they've seen, some of the challenges that have occurred have been purely political. You look at Mexico, for example, which went from the sort of Nieto very pro renewables program where they rolled out an entire investor-friendly setup to bring in outside capital and deploy renewables to the current AMLO administration, which has basically declared war on renewables and sought to totally reverse a lot of the advancements that were made there. You have other problems in places like Brazil where you can't get US dollar denominated power purchase contracts very easily, and so financing those projects is very difficult. I think we have a great system already of trying to find ways to finance a lot of these projects in places like developing economies that are struggling. So you have institutions like the AADB and other development banks that are dedicated to trying to provide capital to these places. But it takes more than just a bit of outside capital. The outside capital only flows if the government regulatory regime is sort of set up in the right way, and they feel like there's not that political risk of kind of whiplash as you change administrations and kind of undoing all the good work you might have seen one administration do. So it's a complicated problem to solve.
All right, makes sense. Well, Eamon, this has been really informative, fascinating stuff. Thank you for joining me here today.
Thanks for having me.
That was Eamon Nolan, who is a project finance attorney at Vinson Elkins. I'm John Jannarone signing off.